Financial Reporting Updates, our webcast series for important issues and developments related to accounting frameworks. Today we present Bringing Clarity to an IFRS World, IFRS Quarterly Technical Update. My name is Andrew McCartney, your host for today's webcast, and I'll be joined on the webcast from others from our national office. A couple of items before I tell you about our agenda and introduce our speakers. In the lower right-hand corner of the screen are the webcast links, including a link to download and print today's slides, and links for webcast assistance and Deloitte updates, upcoming sessions, and archive sessions. If you have a pop-up blocker on your computer, you'll need to disengage it in order to download the slides or participate in our polling questions. And for those of you who have colleagues or know folks that are unable to attend today's live event, they can register and listen to the archived webcast, which will be available within 48 hours after this event. So please feel free to pass on that news to others and invite your colleagues. In addition, although you're on listen-only mode, you can ask our presenters content-related questions at any time by entering your questions in the box at the bottom of the screen and clicking Submit. We'll do our best to respond to your questions and comments during the presentation, and hopefully we'll have some time at the end for Q&As. We also, throughout the webcast, have interactive polling questions that will appear. Again, we invite your participation by simply answering these questions on your screen. A summary of the results will be provided on screen shortly afterwards. So moving on now, let me introduce our speakers and discuss the agenda. First, you'll hear from Diana De Acetis, who will discuss a variety of topics that will assist with completing your year-end financial statements, such as amendments issued and effective for December 31 of this year, including IFRIC 21 and IAS 1 requirements regarding covenant breaches. After Diana, Jon Kligman will discuss a presentation of discontinued operations, restructuring provisions, impairment, and summarize common regulator comments. After Jon, I'll pass it over to Norah Langill, who will discuss the new auditor's report and the 2013 Coastal Framework, and we'll turn it back to Jon afterwards with an update on the IASB project update. We'll conclude, as I mentioned previously, with a brief Q&A session, time permitting. You can also read the bios of our presenters and access the agenda and technical support in the navigation area on your screen. Keep in mind that this is a lot of material for 60 minutes, so we'll need to keep the discussion at a fairly high level. As I mentioned also, time permitting, we will have the question and answer period at the end, and if you do ask questions throughout the presentation, to the extent we're transitioning, I will do my best to ask those questions to our presenters. I'd also like to remind you that the views that we put forth on this webcast are our own views and do not constitute official interpretive accounting guidance from Deloitte. Before taking any action on any of these issues, it's good to check with a qualified advisor. So before we kick off, let's start with our first polling question. And we're going to ask everyone on the line to participate in this webcast with our first question. Don't worry, the results are anonymous. Again, remember, if you have your pop-up blocker, you'll need to disable that in order to see the question. So the question is as follows. The accounting changes affecting 2014 have been relatively less significant than in recent years, but there are two important new standards that were released in 2014 for adoption in the future. They are revenue and financial instruments, effective 2017 and 2018 respectively. Which of these two standards do you think will be most impactful to you, such that you'd like to see them addressed in webcasts in the near future? So again, just pick the response that makes the most sense, and we will cover that in a second. So before we get to commenting on the response here, our webcast is counted towards your continuing professional education. If you stay with us for the entire webcast, you can credit yourself with upwards of 1 hour towards your total for the year. This applies to those in public practice as well as those working in industry. We do not issue certificates for the webcast, but your email registration confirmation can form part of your documentation in support of this. So let's look to the results now if we can. Well, seeing how we're pretty well split right down the middle, I think that means folks on the phone would like to hear from about each of these new standards going forward. So that's helpful for us, and we'll ensure that we take that into consideration in future webcasts. So at this point, I'd like to welcome our first speaker for today's webcast, Diana De Acetis. Deanna is a partner in our national office here in Canada, and she's been with Deloitte for 23 years, is a member of the technical consultations group within our national accounting and advisory services practice. Deanna has served both public and private clients in a number of industries, including telecommunications, retail, and manufacturing. Deanna specializes in a number of IFRS technical accounting topics, including accounting for business combinations, provisions, and impairments. So, Deanna, over to you.
Thanks, Andrew. So we're going to start off with year-end accounting reminders. This slide and the next provides a quick summary of amendments to IFRS standards that are effective for December 31st, 2014 year-ends. The guidance in IAS 32 was tweaked to clarify when you can net financial assets and liabilities, so this will affect financial statement presentation only. Amendments were also made to IAS 36 to remove the requirement to disclose amounts when there's been no impairment or reversal in the reporting period. However, additional disclosures are required when an impairment loss is recognized and the amount is based on fair value less costs of disposal. In terms of IFRS 10, IFRS 12, IFRS 10 was amended to provide an exception to the consolidation requirements for investment entities. It requires investment entities to measure particular subsidiaries at fair value through profit or loss. This also triggers additional disclosure IFRS 12 about the investment entity itself and subsidiaries that have not been consolidated. The last one on the slide deals with employee contributions to defined benefit plans and clarifies the period over which those contributions should be attributed. Amendments have also been made to IFRS 2. The amendments restrict the definition of vesting conditions to include only service conditions and performance conditions, and amend of performance conditions to require the completion of a service period in addition to specified performance targets. Entities that offer options with conditional features should carefully review the amendments, which are effective for transactions on or after July 1st, 2014. From an IFRS 3 perspective, the amendments now make it clear that contingent consideration is measured at fair value at each reporting period, irrespective of whether the contingent consideration qualifies as a financial instrument or a non-financial asset or liability. As a result, any changes in fair value other than measurement period adjustments that are permitted within 1 year of the acquisition date are recognized in profit or loss. From an IFRS 8 perspective, these amendments will impact entities that aggregate operating segments. They are required to disclose those judgments made by management in applying the aggregation criteria. From an IFRS 13 perspective, the amendments clarify that IFRS 13 did not remove the ability to measure short-term receivables and payables with no stated interest rate at their invoice amounts without discounting if the effect of not discounting is immaterial. The amendment to IAS 24 affects those entities where key management personnel services are provided through a management entity. The amendments clarify that the management entity should be identified as a related party, and as a result, the reporting entity is required to disclose the amounts incurred for services paid or payable to the management entity for the provision of key management personnel services. However, disclosure of the components of compensation is not required. We're going to switch gears a little bit into IFRIC 21, which is the new guidance on accounting for levies. IFRIC 21 provides guidance on when to recognize a liability for a levy, which is a payment imposed by government that's made pursuant to legislation or regulation other than one that falls within the scope of another standard, such as income taxes. Levies captured under IFRIC 21 are non-reciprocal in the sense that they do not represent exchange transactions where there's a clear link between the service provided and the amount paid. There are many types of payments that fall within the scope of IFRIC 21, and therefore the scoping part of the analysis is very important. At year-end, it will be key to assess whether you've considered all payments to government, including property taxes, payments for taxes other than income taxes, payments for services that are not paid pursuant to a contract. It's also important when reviewing the legislation that they may not refer specifically to a levy, but it may be called something else. Fee, a royalty, rent, tax, payment in lieu. It's also necessary to determine whether each payment is in the scope of IFRIC 21, and for those payments in scope, to consider whether the payment is triggered at a point in time by specific transactions and thresholds over time or based on multiple factors. And lastly, it's important to consider how that payment is currently being accounted for and whether a change will be required as a result of the guidance in IFRIC 21. The bubbles on the next slide list other items to consider at year-end when reviewing IFRIC 21. So for European subsidiaries, IFRIC 21 is effective in the European Union for annual periods beginning on or after June 17th, with earlier application permitted. So it's not effective for calendar year-end companies in Europe in 2014. So the question is, has management had explicit discussions about IFRIC 21 with their finance personnel in foreign locations on the implications of IFRIC 21 to determine if adjustments will be required up at the consolidated level? From a scope perspective, IFRIC 21 is a broad scope that may impact many different payments that you might not think are within the scope, and therefore it's important to identify all payments in scope by reviewing the applicable legislation. One example is property taxes, where there are differences in how they work. For some jurisdictions, recognizing the expense over time may be appropriate. However, for other jurisdictions, property taxes should be recorded at a point in time. Entities are encouraged to review the discussion of this issue at the IDG meeting in February 2014. How significant is the payment? This is likely to drive the amount of the and documentation that's required. Is the payment made to acquire an asset such as property, plant, and equipment, inventory, a new license, and thus is out of scope? Judgment will be required to differentiate between payments made to acquire an asset that wasn't previously owned or payments made to retain or maintain an asset. Even if the liability is currently recognized progressively, there may be some features of the levy that change the timing of its recognition. For example, are there minimums? In some cases, you may have a levy where there's no rate on the first $50 million of revenues, in which case under IFRIC 21, there'd be no accrual up until that minimum threshold is reached. Other things to look out for are levies with progressive tax rate structures and specified formulas. If the legislation prescribes that a levy is calculated based on a specified formula, it may not match the actual activity during the period. Some levies may be calculated as a fixed percentage times a 12-month rolling average of a specified performance measure, such as gross profit. These are some of the items that companies should consider when evaluating whether IFRIC 21 will change the current accounting practice. This next slide highlights standards and amendments that have been issued but are not yet effective. IFRS 9 is IASB's replacement of IAS 39 for financial instruments. The version issued in 2014 supersedes all previous versions and is mandatorily effective for periods beginning on or after Jan 1, 2018, with earlier adoption permitted, subject to local endorsement requirements. For a limited period, previous versions of IFRS 9 may be adopted early, if not already done so, provided that the relevant date of initial application is before February 1st, 2015. IFRS 15 was issued this year and applies for annual reporting periods beginning January 1st, 2017, with earlier application permitted. This is the new standard on revenue recognition that replaces IAS 11, IAS 18, and all the related interpretations. All entities that report revenue will be impacted in some way by the new standard. Some will see the timing of revenue and profit change. For others, the accounting impact might be less significant, but the new disclosure requirements will have to be considered to understand if new data needs to be accumulated and if processes need to be put in place. From an IAS 40 perspective, IAS 40 was amended to clarify that IAS 40 and IFRS 3 are not mutually exclusive, and the application of both standards may be required. So when an entity acquires an investment property, it needs to determine whether the property meets the definition of an investment property in IAS 40 and whether the transaction itself meets the definition of a business combination under IFRS 3. From an IAS 19 perspective, there's been an amendment to clarify that high-quality corporate bonds used in estimating the discount rate for post-employment benefits should be denominated in the same currency as the benefits to be paid. Therefore, the depth of the market for high-quality corporate bonds should be assessed at a currency level, such as the euro, at an individual country level. We're going to switch gears now and talk about effective dates of new standards. When the IASB issues or amends standards, these standards do not officially become part of the CPA Canada handbook until the Accounting Standards Board has completed its due process to approve the final standards. Therefore, Canadian entities cannot early adopt standards issued until they are incorporated into the handbook. The following standards issued by the IASB have not yet been incorporated into the handbook, being IFRS 9 on financial instruments and IFRS 15 on revenue from contract with customers. The Accounting Standards Board expects to approve and issue final handbook material for IFRS 15 in the first quarter of 2015, and for IFRS 9 2014, the date has not yet been determined. Although the 2014 version of IFRS 9 has not yet been incorporated into the handbook, the 2013 and prior versions are incorporated and can be early adopted. This next slide is a reminder for those entities that have foreign subsidiaries operating in the European Union. In the EU, IFRSs are adopted on a by standard basis. The role of the European Financial Advisory Group, or EFRAG, is to advise the European Union as to whether it should endorse a standard for use in Europe. The EFRAG publishes an endorsement status report periodically, and the last report was dated October 24th. In most cases, the endorsement is expected before the effective date. However, there could be instances when endorsement is expected to be after the effective date of the IASB standard. In these cases, the IASB cannot be adopted by the entity in Europe. For examples, refer to the last 3 rows of the slide. The EU endorsement status report is particularly important if a Canadian company is a subsidiary of a European parent, or is a parent company that has European subsidiaries. So we're going to move next into year-end accounting reminders. So the first is a breach of covenants. This is just a reminder around the requirements of paragraph 69 of IAS 1 that an entity shall classify a liability as current when it expects to settle the liability in the normal operating cycle. It holds the liability primarily for purposes of trading. The liability is due to be settled within 12 months of the reporting period end, or the entity does not have an unconditional right to defer settlement. In addition, just to note, the IASB has a project to develop a more general approach to the classification of liabilities under IAS 1 with some contractual arrangements in place at the reporting date. This project was added to the IASB's agenda in February of this year, with an exposure draft expected in the first quarter of 2015. This next slide is a decision tree to help walk through the guidance in paragraphs 74 and 75 of IAS 1 regarding the breach of banking covenants. So the first step is to consider whether or not a breach has occurred on or before the end of the reporting period. If so, has the entity obtained a waiver on or before the end of the reporting period that provides a period of grace within which the entity can rectify the breach and during which the lender cannot demand immediate repayment for at least 12 months after the reporting period end. If such a waiver has been obtained, then it would be appropriate to classify the liability as non-current. However, if there's been a breach subsequent to the reporting date, or if one is forecasted, additional note disclosure should be considered. If, however, an appropriate waiver has not been obtained on or before the reporting period, the liability would need to be classified as current. And further, it's important to note that if there's a breach of covenants and the entity obtains a waiver between the year end and the date the financials are issued, the loan is still classified as current under IFRS. So with that, I will turn it back to Andrew.
Thank you, Deanna. Before we move to our next speaker, if we could go to our second polling question, please. And the question is as follows. Do you expect to have any indicators of impairment for assets at year end? So the choices are, yes, we expect to have market cap issues. Yes, we expect to have indicators of impairment other than market cap issues. No, we do not expect to have any indicators of impairment, but we have to perform our annual impairment testing of goodwill at year end. Or no, we do not expect to have any indicators of impairment and do not have any goodwill. We'll wait to see, or not applicable. So please go ahead and as I said, respond to that question, and we'll see what the responses are in a second. Deanna, in the interim as we wait just for people to populate the responses, I would like to ask you a question that came in through our question process, and it reads as follows. Are you aware of any entities contemplating early adoption of IFRS 9 and IFRS 15?
Thanks, Andrew. Yes, I am aware of some entities that are contemplating early adoption before the effective dates. It's important that, as a reminder, a Canadian company cannot adopt a new standard until it's been incorporated into the handbook, and IFRS 9 and 15 have not yet been incorporated. Just as a further note, both standards are quite complex and detailed, and with early adoption, there's always a level of risk that views will evolve as areas of interpretation and application continue to be worked through. So anyone contemplating early adoption is really encouraged to consult with their advisors.
Thanks, Deanna. If we could go to the responses to the polling question, please. So just quickly looking at these, I think there's a little bit of the unknown still here. Some testing has to happen. There's not a lot of individuals on the phone that don't believe, but less than 20% don't believe there will have impairment issues, but there certainly are some that still need to do their work at the annual test. So it's interesting just to see, and then others that it's not applicable. So that's helpful information for us just to understand where the marketplace is and what we see happening out there. So thank you for the responses to that. Next, I'd like to welcome our next speaker, Jon Kligman. Jon is a partner in the Canadian National Office and has been with Deloitte for 27 years and is a member of, similar to Deanna, our Technical National Accounting and Advisory Services Consultation Group. Jon specializes in a number of IFRS and ASB technical accounting topics, in particular accounting for income taxes, foreign currency translation, related party transactions, and business combinations. He's also a regular facilitator for our internal technical training sessions. So, Jon, over to you.
Thanks, Andrew. Hi, everyone. So what we'll do is a quick review of the criteria for discontinued operations classification and treatment. If you look at the top of your screen, there's a definition. A discontinued operation is a component that either has been disposed of or is classified as held for sale and represents a separate major line of business or geographical area of operations, or is part of a single coordinated plan to dispose of a separate major line of business or geographical area of operations, or finally, is a subsidiary acquired exclusively with a view to resale. Just focusing on a couple of the elements of that definition. Component, the first part, or what you see on the screen, should be familiar to you. It represents operations and cash flows that can be clearly distinguished operationally and for financial reporting purposes. But what's not on the screen is the other part, and people may not be aware of it, or it may not be obvious to some people. A component also has to be a cash-generating unit, as defined in IAS 36, or a group of cash-generating units. And that's something we did not have on old Part 5, and that's because we didn't have the concept of CGU. The other element of the definition we might want to focus on is the assets have to be classified as held for sale. And, of course, the standard does have specific criteria for classification as held for sale. You see at the bottom of your screen there's a couple of them. They have to be available for immediate sale in their present condition, and sale has to be highly probable. There's also a bunch of others that aren't on your screens. For example, the company has to have an active plan to locate a buyer, and it has to be expected that the sale will be completed within a year. Those various criteria, again, are ones that you should be familiar with because they are modeled a lot on really what was FAS 144 in the U.S. and what we had in Part 5 of Canadian GAAP. So moving along to the presentation of Disc Ops, again, if you look at the bottom of your screen, this should be familiar. Single line item, which includes both the operations, the actual operations of the disc op for the period, as well as any gain or loss on disposal or a loss on writing it down to fair value less cost of sale if that's lower than the carrying amount. At the bottom of your screen, you'll see disclosure requirements, and basically the top part of that bottom section deals with the various elements of the single line item included in the discontinued operations line. In addition to that, and this is something we did not have before, there is a requirement under IFRS to disclose the net cash flows from discontinued operation attributable to operating, investing, and financing activities, and the disclosures have to be comparative, as well as the presentation. So moving on to the next slide, the do's and don'ts of disc op presentation and what goes in and what's out. So this is a list of items that should not be included in discontinued operations. The first one being profit or loss from continuing operations. For example, that would be a gain or loss on assets that are held for sale, but that don't constitute a separate major line of business because it's just not big enough. Second item is share of discontinued operations of an equity method investee. What that's referring to is a disc op of the equity method investee itself, so either the associate or the joint venture, as distinguished from the equity method investee as a whole. Unlike Part 5, under IFRS, it is possible for a complete associate or joint venture to qualify for disc op treatment, provided it constitutes a major line of business. And that would it wouldn't be common, but it would happen, for example, where the top company conducts most of its operations through, say, joint ventures. So just to distinguish that, it's just what we're referring to there is simply the disc op of the associate itself doesn't qualify for disc op treatment in the investor statements. Third item is the allocation of cost of an asset that's not available for immediate sale in its present condition. What they're referring to there is, for example, say you have a computer system that's used by the discontinued operation, but it's also used for other operations. You cannot include any part of the cost of that equipment in the disc op, even if, for example, due to the disc op situation, it's caused an impairment in that equipment. That impairment itself would not go in the discontinued operations line. The next item is routine disposals of components. And an example of that would be, say you have a retailer with lots of locations and they close or sell a particular location. Presumably that individual location would not represent a separate major line of business. So even though it might be a component, separately distinguishable cash flows, and it may be a CGU, but it may not be large enough to be a major line of business and so would not qualify for disc op treatment. Disposal of a portion of a component, well, the definition requires that in order to be a discontinued operation, it has to be a component. So there, obviously a portion of a component would not qualify. And the last item on your screen is the allocation of corporate overhead costs that are not clearly identifiable as costs of the component being disposed of. An example would be allocation of head office management salaries on some kind of formulaic basis. So if those individuals are not exclusively devoted to the discontinued operation, but the internal reporting of the company routinely allocates a portion of their salaries on some kind of formula basis, those salaries or that portion of it cannot be included in the discontinued operations line. Okay, moving on to restructuring provisions. That's recognition of liabilities related to restructurings. You'll see at the top of your screen examples of restructuring activities. Generally, under IAS 37, in order to have a provision, in order to record a provision, there are certain criteria that are set out, one of which is you need to have either a legal or a constructive obligation. And if you go to the middle of your screen, that's really taking the criteria for legal or basically constructive obligation and applying it to restructuring activities. In other words, when would you have a constructive obligation in connection with a restructuring? So there's two basic criteria. Number one is you need a detailed formal plan for the restructuring, identifying the key elements of that plan, and they're listed on your screen. The second criterion being that you need to have raised a valid expectation in those affected that will carry out the restructuring, And what that means is that you have to either have started to implement the plan or you had to have announced the main features of the plan to those affected by it. Now, under IFRS, as really in contrast to old Part 5, it's a more, streamlined approach as to when you recognize these things. If any of you remember having to deal with the convoluted EIC 134 under Part 5, really the message here, this is a lot simpler, but obviously you've got to meet these criteria. One other point not on the slide is that the implementation needs to be planned to begin as soon as possible and to be completed in a time frame that makes significant changes to the plan unlikely. So moving on in terms of, what's the situation at the balance sheet date, and do you recognize the provision at that point in time? So the question is, in the middle of your screen, does the requirement for the existence of a valid expectation and those affected related to the situation at the end of the reporting period? So the question is, the issue is, well, what if you either, say you announce the plan in sufficient detail to the people who are going to be affected prior to the financial statements being authorized for issue, but after the balance sheet date, and say management or the board has actually approved the plan, that would not be sufficient to record it at the balance sheet date, even though the valid expectation was created prior to authorization for the financial statements. Because the plan was not announced or didn't begin until after the balance sheet date, that would not qualify for recognition at the balance sheet date because you don't have a constructive obligation, but obviously there'd be subsequent event disclosure required. Okay, moving on to IAS 36, certainly one of the more challenging standards to apply. So assets are tested for impairment under that standard at the level of an individual asset or at a cash-generating unit level, or CGU. And if you look at the box toward the top of your screen, there's the definition of a CGU, and it's the smallest identifiable group of assets that generate cash inflows that are largely independent of the cash inflows from other assets. The fact of life is simply that it's not all that neat, and individual assets don't usually generate cash inflows in isolation. And so some kind of grouping is required. Under IAS 36, the recoverable amount is the higher of the fair value less cost of disposal and the value in use. And usually, to determine the value in use, which is an entity-specific measure, you usually need to group assets together because you usually need a group of assets to generate cash flows. Now, there is an exception. If you look toward the bottom of your slide, when the fair value less cost of disposal of an individual asset can be determined, the recoverable amount can be determined for that individual asset subject to certain conditions, conditions being, for example, that fair value less cost of disposal of that individual asset exceeds the carrying amount, which would mean you don't have an impairment in that asset, and you don't even have to worry about value in use. Or, for example, another example would be where the fair value less cost of disposal is close to the VIU of that asset, and that would happen rarely. It would usually happen when you're planning to sell the asset in a relatively short term. If it's close to it, then again, you don't have to worry about the VIU, and you can determine the fair value of the asset less cost of disposal on an individual asset basis, but that would usually be an exception. In terms of grouping CGUs, if you look at the bottom bullet on your screen, they can be grouped for goodwill impairment testing purposes if management tests goodwill at a higher level. So that is based on the level at which management monitors and tests goodwill. So say, for example, they will test goodwill related to two CGUs together. So for purposes of testing goodwill impairment, you group the CGUs. You still test each CGU separately for impairment, but for the goodwill, because it's monitored at a higher level, you group it. And that group, it says grouping doesn't extend to most other assets with an emphasis on most. An exception might be corporate level assets, where if you cannot allocate reasonably a corporate asset to an individual CGU, you would basically allocate it at the lowest level of CGUs where it can be reasonably done. So you might have to do it on 2 or 3 CGUs. And then you test those 3 or 2 CGUs together with the allocation of the corporate assets for impairment of those corporate assets. Again, you would still test each CGU separately without the corporate assets for impairment, but then in order to test the corporate assets, you have to do some kind of an allocation. So moving on, something that has been topical lately is market cap. Market cap is basically the total market value of an entity's outstanding shares, price times quantity, or P times Q, if you will. And market cap is included as one of the external sources of information that's considered an indicator of impairment under IAS 36. But beyond that, IAS 36 doesn't provide any specific and explicit guidance on the application of market cap in the context of impairments. So what do? Well, you go on to the next slide. That's what you do. The question here is, in general, will a formal impairment test always be required when the market capitalization of an entity is lower than its net carrying amount? The short answer is not necessarily under existing standards, but you can't look the other way. And just a note that there is an exposure draft out on fair value of quoted investments in subsidiaries, joint ventures, and associates that could possibly change things, because the proposal in that is that fair value equals price times quantity without any adjustment. There has been some pushback on that exposure draft, but the comment deadline isn't until mid-January, so just have to watch out for that. So the guidance on this slide is based on existing standards, and obviously that's relevant for this year's year ends. So some of the factors and questions that you would look at if market cap is below carrying amount, the reason for the excess, for example, can it be explained? Is its existence of that excess due to a control premium, and can that be reconciled? The duration of the shortfall, is it just a market blip or a market trend? The amount of the shortfall, has it been increasing over time? Is it beyond reconciliation? The results and dates of the last impairment test, those impairment tests identify factors and assumptions that are particularly sensitive to changes in the market and the economy. And what is the likely impact on those changes in the market and the economy on those particular factors and on the recoverable amount? And just the last item on the slide is that if you've acquired a CGU in a recent acquisition and the timing of that was such that market conditions haven't changed and the economic outlook hasn't changed significantly since the date of that acquisition, it probably is not likely that that CGU is impaired at this particular point in time. And just the last point on, not on your slides, but just on IAS 36, I just happened to notice this morning that there are about 4 issues related to IAS 36 that are on the agenda of the next meeting of the IDG or the IFRS discussion group here in Canada. And that meeting is on December the 9th. So look out for that. There might be some clarity coming out of that that you might find useful. Okay, year-end regulatory reminders. If you look at the list, it's the usual suspects. If you look at the list of topics, some of them we've discussed already. There are areas involving complex accounting, areas of interpretation and judgment, or areas where there's enhanced disclosure requirements. I should note that this list is not based on any single report, but it's really an amalgam of comments that have been received over time. We've talked about some of them. I'm just going to comment on a few. Revenue recognition, of course, that's significant, and it can be complex, particularly where you have complex arrangements with customers, like bundled products and services, principal versus agent considerations, upfront payments, bill and hold arrangements. The accounting policies have to align with the revenue streams. Regulators have also commented that some of the disclosures about the accounting policies have just been boilerplate. There hasn't been enough information regarding the judgments applied in determining the policies. Fair value measurements, IFRS 13 is still new. So there are lots of areas of interpretation, and some questions that have arisen is, are the assumptions reasonable and are the methodologies appropriate? Also disclosure requirements. There are significant disclosure requirements that have not been complete sometimes in practice. Moving on to segments. Who's the chief operating decision maker? Is it the CEO? Is it the COO? Is it the management committee? Do other parties or some of these other parties review more disaggregated results than the CEO? And does the chief operating decision maker review disaggregated information beyond what is in the chief operating decision maker package? There have also been questions, as it shouldn't be a surprise, regarding the aggregation of segments. Disclosure of interest in other entities, IFRS 12 is also new, and often there is insufficient disclosure of the significant judgments and assumptions that went into determining whether the company has control, joint control, or significant influence in the investee. And just a final note on this, that we do have a webcast on highlights from the AICPA National Conference on current SEC and PCAOB developments coming up on December the 18th. And with that, I will turn it back to Andrew.
Thank you, Jon. And before we move to our next session, I would like to ask you a question that has come in through the interactive question function, and reads as follows. We're planning on having a restructuring at year-end, and our plan does not specifically identify which individual employees will be terminated under the plan. Can we still record a provision?
Yeah, thanks, Andrew. The answer is yes, assuming the other criteria in IAS 37 are met. The detailed formal plan has to identify the location, function, and approximate number of employees who will be compensated for having their services terminated, but it isn't necessary for the plan to be so detailed that it identifies the individuals who are going to be leaving. But it has to be sufficiently detailed that those employees in the employee groups that are affected by the restructuring plan have a valid expectation that either they or their colleagues in the group will be affected.
That's great, Jon. Thank you. I'd now like to welcome our last speaker, Norah Langill. It will not be our last session of the day because Jon will be back with us at the end. Norah is a senior manager in our Canadian national office. She works in our technical assurance consultations group. She's been with Deloitte for 16 years and has served both public and private clients during that time across a number of industries. She currently focuses her time on a variety of assurance-related topics. So, Norah, over to you.
Thanks, Andrew. Proposals have been issued by both the Canadian Auditing Assurance Standards Board as well as the International Auditing Assurance Standards Board for somewhat significant changes to the auditor's report that we currently know. The proposals move us away from the current standardized one-page report to one that is significantly longer and more client-specific. This slide highlights some of the proposed changes, such as the reordering of paragraphs, the expansion of some existing sections, such as the responsibilities of management and of the auditor, and the most significant proposal is for the auditor's reports of listed entities to include a new section for key audit matters. The goal here is to provide transparency about key matters of audit significance that are likely to be the most important to users of the financial statements and the audit. When no items are mandated, the auditor will consider including items such as significant risks, audit implications of unusual or significant items, significant qualitative aspects of the entity's accounting practices, including accounting policies, estimates, and financial statement disclosures. The final IAASB standard is expected in early 2015, but this will not be applicable in Canada until the AASB issues their own finalized standard, and those deliberations are currently in process. So why are the changes being proposed? To provide more transparency about the audit that was performed, to enhance communications between the auditor and those charged with governance, to increase the attention by management and those charged with governance to the matters disclosed in the auditor's report, which may result in improvements to the quality of financial reporting, and to renew the focus of the auditor on matters to be reported, which could indirectly result in an increase in professional skepticism and contribute to audit quality. In this next section, we're going to address briefly the 2013 COSO framework and how it differs from the 1992 framework. We will highlight areas of the most significant change and will briefly address some implementation issues. In 2013, the Committee of Sponsoring Organizations, or COSO, issued a revised version to its 1992 internal control framework. COSO was motivated to update its framework to address significant changes in the nature of the businesses, the environments they operate in, both of which become increasingly complex, technology-driven, and global in the last 20 years. Fundamental changes embodied within the 1992 framework have been retained. For instance, the definition of internal control remains fundamentally the same, and the three categories remain the same, being operations, financial reporting, and compliance with laws and regulations. Second, the 5 components of internal control remain the same, being control environment, risk assessment, control activities, information and communication, and monitoring. And importantly, the 2013 framework continues to recognize the use of judgment, although it should be noted that in the context of applying the framework for regulatory purposes, including for compliance with Section 404 of Sarbanes-Oxley, those judgments need to be made within the parameters of the related requirements. So for companies, that would be the SEC's guidance for management, and for auditors, it would be PCAOB's auditing standard number 5. Probably the most significant change in the 2013 framework relates to its structure. The new framework creates more formal structure around the design and evaluation of the effectiveness of internal control. First, the new framework uses principles to describe the components of internal control. There are now 17 principles that explain the concepts associated with the 5 components of the COSO framework and 87 points of focus, which are important characteristics of the principles. Along with the principles comes a more formal way of designing and evaluating internal control, in that there is now a need to evaluate whether each principle is present and functioning, and also whether the principles function effectively together. In addition, the 2013 framework adds and refreshes guidance with respect to each of the 5 components. This next slide highlights specific areas that, based on the comparison of the 1992 framework to the 2013 framework, represents the areas of most significant change. The risk assessment component has received a fairly large facelift, including more detailed discussion of risk assessment concepts, more specifically addressing the linkage between risk assessments and the related control activities, and the introduction of a new principle, number 8, that specifically addresses the fraud risk assessment process. In addition to the risk assessment as a whole, 2 other concepts that appear more prominently throughout the new framework are IT and outsourced service providers, or OSPs. The new framework specifically addresses how internal control extends to an entity's outsourced service providers, and the role of information technology in internal control is prominently addressed throughout the framework. Both concepts are embedded in the framework's principles, with OSPs being mentioned in 12 of the 17 principles, and IT being noted in 14 of the 17 principles. These areas are also likely to represent those where transition to the new framework might be the most challenging to implement. Transition is a big question to those currently using the 1992 framework for the purposes of complying with SOX 404. COSO has provided transition guidance by stating that the original framework will be superseded as of 12/15/2014. The SEC has not, however, issued formal transition guidance. The SEC Chief Accountant, Paul Beswick, has informally referenced the COSO transition guidance and has indicated the SEC staff will monitor the transition to evaluate whether future action may be necessary or appropriate. The PCAOB also has not issued transition guidance to auditors. However, PCAOB Standard 5 requires the auditor to use the same internal control framework used by management. It's our understanding that both frameworks will be acceptable for this calendar year, and we encourage disclosures around the framework used.
And it seems that we have lost Nora's connection on the phone here. So,
no. Sorry, Andrew. Over to you.
All right. Thank you, Nora. If we could move at this point to our third polling question. So the question reads as follows. Will the new 2013 COSO framework affect your organization for the current year end? Answers are yes, we have adopted a new framework for this current year end. No, we are not an SEC registrant. No, we will not be adopting the new 2013 COSO framework for this current year end. Fourth option is we're continuing to assess the question, or the fifth one, not applicable. And as we wait for that, Nora, assuming your connection is working fine now, I do have a question that came in because I know you spoke about auditor reporting, and the question was, are there any live examples of companies that are currently reporting under the new audit report format? It would be interesting to see what items are reported under the new key audit matters section.
Sure. Okay, so currently there are no Canadian examples of reporting under the new audit report format, with the international standard just being finalized and coming into play early in 2015, and the Canadian one still in progress. We don't expect to see examples until 2015 or possibly 2016, depending on when the Canadian standard is finalized, because that's really the driver for us. We are, however, aware of some examples of reports in the UK, but they're under a slightly different framework.
Great, thanks, Norah. If we could get the results of the polling question at this point in time. And just looking at it here, first, about 23% have adopted a new framework. A number have said they're not an unnecessary registrant, and others have said they will not be adopting, and others looking to assess a question. And I know a lot of Norah's discussion was in respect to the SEC requirements around this, but also, obviously, as a Canadian reporting issuer, it is relevant also for management's certifications in respect to controls, so something to be looked at that way. Obviously, a lot more focus is often given from the SEC perspective and the integrated audit concept, but it does exist in Canada also. So with that, we'll pass back to Jon for the final section of the day's presentation.
Thanks, Andrew. Just going to the IASB work plan. I think you'll notice on your slide that it's as at October 28th, which was 4 weeks ago, and it turns out just this past Monday on the 24th they've updated it. No significant changes. I'll just point out the one or two changes that happened. Leases, the second item, we have separate slides on that one. Just a couple of quick points on this slide. The conceptual framework. The upcoming exposure draft is going to address things like the elements of financial statements, additional guidance to support the asset and liability definitions, the definition of equity and distinction between liability and equity elements, and the presentation in the statement of comprehensive income. Dynamic risk management, what that is, it's macro hedging, and that's going to be decoupled from IFRS 9. In effect, what that does is it marries risk management practices to financial reporting to make it more realistic. And on rate-regulated activities, the paper, one of the things it's looking at is whether rate regulation or the common features of rate regulation create additional assets and liabilities that should be accounted for. And moving on to the next page of the work plan, the exposure draft related to share-based payments, coincidentally, that one was published yesterday. It deals with three main things. One is how performance conditions should be reflected in the measurement of cash-settled awards, and the answer or the proposal there is the same approach as for equity-settled awards. The second item is clarification of how to account for share-based payment arrangements in which cash-settled awards is canceled and replaced by a new equity-settled award with a higher fair value. And the proposal there is that difference would be recognized in P&L immediately. And the last item that it's dealing with is share-based payments settled net of tax withholdings, and whether if the award is otherwise equity-based, whether that settlement feature has to somehow be treated as cash settled, and the proposal is no, that the entire award would be classified as equity settled. Regarding the amendments to IAS 1, the final standard, which is expected next month, is going to deal with things like additional subtotals, ordering of notes, materiality. And the next item, the elimination of the gains and losses on transactions with an equity method investee, like an associate or joint venture. That's one where the actual timetable has changed. That's deferred to Q1 of 15, and what that is dealing with is how do you deal with situations where the amount to be eliminated exceeds the actual carrying amount of the investment. Investment entities, three proposed amendments, one of which is that if you have a non-investment entity investor, an investment entity, associate, or joint venture, you can retain the accounting by the investment entity when you apply equity accounting. In other words, you can fair value the investment. You don't have to undo it for equity accounting, even though you're not an investment entity. The second item that's dealing with is subsidiaries that provide services that relate to the parent's investment activities. If that subsidiary, even though it does that, but still meets the definition of an investment entity, it does not have to be consolidated. It would be recognized at fair value. And the last item that's dealing with is we have a chain and you're a company within a chain, and it's the exemption from consolidation. That what if your parent's an investment entity and it's going to recognize what you've got at fair value anyway? Does that mean that you can still opt not to consolidate? And the answer is yes, you can. Okay, moving on to leases. The first slide, really, the thing to really focus on here is the last item, is that the standard is expected in the second half of 15. And then moving on to the quick needs to know, significant change here in accounting by lessees, that all leases in effect would be capitalized except for short-term leases and small ticket items, that the lessee would record a right of use asset, which would include the present value of the lease payments and their initial direct costs. In addition to that, there obviously would be a lease liability equal to the present value of the lease payments. On the P&L, obviously there's going to be an impact that it's no longer going to be straight line if you would have otherwise have had an operating lease, and that's because of amortization of that lease liability. And just like in mortgages, the expense is higher in the earlier periods. So it's front-loaded, and it's not going to be converged with FASB. FASB is proposing two approaches to lessee accounting. Both would involve capitalization, but under one, namely real estate kind of leases, you can still recognize the expense straight line even though you capitalize it. And just moving on to the last slide on leases, life isn't as neat as what's depicted here, but sort of directionally, if you look at the green line, under operating lease treatment, you would have expense straight-lined. The blue line represents the rental expense, of course, not as neat as this, where you have stepped-up rent over time, so it's increasing. And under the final, what will probably be the final standard on leases, you can have higher expense in earlier periods due to the amortization of the lease liability, the interest expense on that, and lower expense in later periods. And with that, I will turn it back to you, Andrew.
Thank you, John. We can jump just to the next slide here. What this slide is showing actually is we're introducing a new bi-weekly financial reporting communication titled Stay on Top of Financial Reporting. This communication is a consolidation of previous newsletters that you may have seen in the past, including Deloitte Link, IFRS in Focus, State of Change, and Standard Setting Activities Digest. You'll find information on all financial reporting frameworks in Canada and potential impacts resulting from recent developments to your organization. Our recent communication released on September 11th includes publications and events related to standard setting activities, new events, tools and resources that will come in handy for your organization, as well as a business news highlights to keep your company current. We'd love to hear your thoughts on what you may want to see in future releases, so please feel free to share your comments or request a copy by contacting us at financialreporting@deloitte.ca. The email address is on the slide there. So before we jump to our Q&A session, and we will have a couple of minutes, we do appreciate your feedback, and would like to, well, you will see a pop-up of a survey appear on your screen shortly. We kindly ask that you do fill this out for development of our future webcasts. We take these surveys seriously and really look for feedback to help us drive content on future webcasts to ensure we're dealing with the subject matter that people want us to. Also, if we don't get to all of your questions today, and a number have come in, particularly if they're regarding specific fact patterns for your organization, I'd recommend reach out and discuss the questions with your local Deloitte partner or Deloitte contact, and they can hopefully work with you to resolve any questions or concerns you may have. So just looking here, I will jump into the couple of questions here. So first off, Deanna, I have a question for you that's come in, and it reads as follows. When do we expect IFRS 9 and 15 to be incorporated in the CPA handbook and available for adoption in Canada?
That is not expected to happen until early 2015, Andrew.
Okay, so that's kind of a little bit of time there still, but it is coming along fairly soon. So let me see here. John, I have a question that has come in that's probably closer to what you, some of the matters you spoke about. and reads as follows. You mentioned an investment entity may have to consolidate certain subsidiaries. Can you elaborate in respect to what you were referring to?
Okay, so if an investment entity has a subsidiary whose primary function is to provide investment-related services to the investment entity, that subsidiary has to be consolidated. And those kind of services would include things like investment advisory, investment management services, and other services described in the standard. Those services are considered to be an extension of the operation of the investment entity, and that's why they would be consolidated. In contrast, if the subsidiary provides some investment-related services, but is primarily an investment entity in its own right and meets the definition of an investment entity, in that case it would not be consolidated. So judgment is going to be required in practice to determine if that's the case.
Thanks, John. And I do see that we are now up against the hour mark, and I do want to be respectful of people's time, so I will close off the Q&A session at this point in time. Thank you again to all of our speakers today, Diana De Acetis, Jon Kligman, and Norah Langill. We hope you have found this webcast helpful and informative. If you want additional information, please visit our website at www.deloitte.ca. And to all of you viewing our webcast today, thank you for joining us. This concludes our Bringing Clarity to an IFRS World, IFRS Quarterly Technical Update webcast. Thank you.